Is Scott Wohlers with River Place Capital. It is Thursday, June the 18th, and wanted to take some time and go over what we've seen in a very wild and crazy weeks in the stock market. And as we were talking last Thursday, we were in the midst of a sell-off that we hadn't seen since March, and that was all under fears of the resurgence of the coronavirus coming back. Is it going to have an impact on the economy? Is it going to negatively affect markets? Is it going to slow down what is the current economic recovery? And then Friday we started to recover a little bit as it was kind of a typical oversold action in the market. So we saw a bounce off of those lows on Friday, and we came into the week on Monday, and we actually opened up the day on Monday actually down 600 points on the Dow. And as the day continued to move on, we started to get more and more headlines. And one of the things that we've talked about and discussed is during this time frame before we start getting into earnings season and start understanding what companies are seeing in consumer activity, we're going to move on headlines, whether it's economic headlines or whether it's headlines from the Fed, whether it's information about the virus, whether it's information about possible therapies, vaccines. Those are the things that are going to move the markets as we continue through all of this until we can get some more clarity and certainty from what companies are doing. And then you saw a big rally Monday afternoon in the markets when the Fed came out and said that they are going to start buying individual bonds of companies, which is another way of injecting liquidity into the system, allowing these companies to add cash to their balance sheets by the purchase of these bonds from the Federal Reserve. And then we wake up Tuesday morning to see record increase in retail sales month over month from the month of May versus the month of April, which is a great indicator that we are starting to recover, and maybe the recovery is going to be sooner than we had feared, and as economic experts had feared, that we might be starting to bounce back. Consumers are spending more money. That is very important because our economy is 70% based upon consumption. So we got those numbers on Tuesday as well. On Tuesday, another very good leading economic indicator is the Home Builder Sentiment Index. And we saw the largest ever increase month over month on the Home Builder Index. And the reading came in at 58, and it was a 21-point jump. And what's significant about that is for a healthy housing market, that index needs to be above 50. And that 58 number is well above 50, which provides, and the housing market is incredibly important to the stability of our economy moving forward. So as interest rates stay low and you can get record low mortgage payments, people are going out who can buy and have been sitting on the sidelines, are starting to enter in the market to buy houses. And the other thing to think about too, as we go through all of this uncertainty and we move headline to headline, how can this market continue to move up with our current existence? And just kind of to kind of hammer this point home that we've talked about several times, is when markets have very low interest rates, like you're seeing in the 10-year treasury rate, well below 1. Savings accounts are paying virtually nothing. CDs are paying virtually nothing on money. And you have plenty of liquidity in the system. That money has to go somewhere. And when low inflationary environments, the place that money goes to is into the stock market. And think of it, as we talked about housing, think of it about bidding on a house. If you are in a bidding war with many, many people trying to buy one asset, well, the value of that asset's going up as one's trying to outpurchase and outbid the other. Well, we have all of this liquidity in our system, and it's all flowing, or a lot of it is flowing into the equity markets, causing them to be inflated because the money has to go somewhere, and that's where it's going. So if you have any questions about what's going on within your individual portfolio or what we see economically and how that's going to impact you, as always, feel free to give us a call. We love hearing from you. We love talking to you about it. Reach us here at the office at 904-346-3460, or as always, check us out online at www.rpc.com. shop.riverplacecapital.com. And I hope everybody has a wonderful rest of your week. Thank you.